Greetings, single point clients and friends. Rene Jarquin coming to you on a Friday afternoon. I woke up this morning thinking about market concentration. I think for those of you who have heard my take on where we are currently market-wise, you've probably heard me say that the S&P 500 index, which is the kind of the anchor piece of our clients' equity portfolios, has become very lopsided by virtue of the incredible run-up that we've seen in the Magnificent Seven, is the shorthand for the 7 largest stocks in the index, which have really, in some ways, obviously, as indexed investors, we've benefited from that massive rally. But at the same time, it has caused me some anxiety. Having lived through the dot-com bull market frenzy, I would say, of the late 90s, early 2000s. Of course, a lot of the the parallels aren't exact. These 7 companies, these big tech platform companies, are amazingly profitable in a way that 24 years ago the dot-coms were not, or even the infrastructure providers to the emerging internet boom back then were not. But nevertheless, looking at this on the basis of well-known valuation or relative valuation metrics, it would seem that the S&P 500 is trading at levels that are historically high. So I thought I'd spend maybe 7-10 minutes today just walking you through what's been going on, as well as what's been going on this year, year to date, but also what's been going on this week, which I think is also a very interesting time to be catching up. We got some very encouraging inflation data yesterday. That's 2 months in a row that shows that inflation is really cooling. And in general, I would say the economy is cooling. All of the economic research that we look at suggests that that's absolutely the case, though it does not seem to be collapsing into a recession. So far, it's just an economy that's coming off of a very hot period of stimulus, right? From a lot of the infrastructure, federal stimulus, and before that, a lot of the COVID stimulus. But let's look at some numbers, and hopefully after this video, you guys can kind of walk away with a better understanding of what's happening beneath the surface of the index. So let me first start. This, by the way, this chart is courtesy of our friends at Goldman Sachs. And this graph charts the concentration of not the Magnificent Seven, but of the Magnificent Five. NVIDIA and Tesla are not included in this chart. So these 5 names at the beginning of 2024 were close to 25% of the index, of the 500 index weighting. If you add NVIDIA and Tesla, you get to about 30%. Okay, here's a little bit more of a clearer breakdown of the weightings. Microsoft is by far, or not by far, but it's the biggest. And curiously enough, if you were to look at the 5 largest stocks in 2000, the only one that's left of that grouping from 24 years ago is Microsoft. The other ones were GE, Exxon, Cisco Systems, and I forget there's a 5th one. But fast forward to today, these are the Mag 7. There's 8 positions because Alphabet's the parent company of Google. They have 2 separate share classes. But collectively, they represented about 30% of the weighting of the index. And the other 493 names, about 70%. Over the course of the first half of the year, roughly the first half of the year, the headline index returned 17%. Of that, the Mag 7 were 10.6 of that. And the other 493 names contributed 6%, a little bit over 6%. Okay, let me see if there's perhaps a little bit of a better graphic here, a better visual. Using our Y charts application here, I've plotted kind of a similar idea using actual ETFs, exchange traded funds. This one here in purple is called the MAGS 7 ETF, which tracks those 7 names. This is the year-to-date total return. You can see that it's up 42%. The middle line, the light blue line, is the S&P 500 index, that's the core holding in our client portfolios. And that one's returned just under 18% year-to-date through yesterday, Thursday. And then the orange line is an approximation. It's not exact, but it's pretty close to what would be an index that tracks basically everything but the MAG 7. So think of the orange line as the line that graphs the return of the S&P 500 as if the MAG 7 were flat during this period, right? So if the MAG 7 had not done 43%, but instead were 0, the return of the S&P 500 would look like this orange line at just a little bit under 7%, right? So what you see here is a pretty unique, by historical standards, dispersion between these top 7 names and the rest of the index, which, encompasses all the other sectors, right? Utilities, banks, energy firms, consumer staple or consumer packaged goods firms, and so on and so forth. So the question, of course, or the concern for me is, how does this kind of look on a kind of longer term basis, these movements? And let me flip over to my next visual, and you'll forgive me, it's a little bit busy, but this one is a really powerful slide. Let me describe in high level, focus on these 2 graphs, the orange and the blue line. The orange line plots the valuation multiple of the S&P 500 index, the core index. Currently, it sits at about 24 times, it trades at about 24 times the value of the trailing 12 months of earnings. Okay, that's high. The historical average is closer to 18 times earnings across all the cycles. We saw that it peaked at 30 times coming out of the pandemic with all that massive stimulus, both fiscal and monetary. It peaked at about 20 times after the financial crisis. But in general, over the full market cycle, it averages around 18, 19 times. So it's stretched, and that's a big part of the reason why you may have been hearing me over the last 6 months talk about, rebalancing back to our stock and bond targets and, on the margin, build up those bond buffers a bit and trim some of that, return, some of that, gain that we've seen as this PE multiple has expanded over the course, not just of the last 6 months. It's been on an upward trend powered by the MAG 7, probably since Halloween of 2022, which is when the bear market of 22 bottomed. Okay, the blue line here gives me a little bit of hope because this is that hypothetical index of that excludes or neutralizes that very heavy weighting to the MAG 7. So think of this as being the PE multiple for the rest of the market. Okay, and that PE multiple, that valuation multiple, is much more in line with the historical average, right? And so what you see again is, this very high valuation multiple on these, very exciting AI-driven tech platform companies. For the rest of the sectors, right, the lion's share of the components of the S&P, the valuation multiple is very reasonable. And for that reason, I feel that this is a little bit different than, going back to the dot-com era or going back to the peak that we saw before the 2022 bear market. And this component here is very responsive to what happens in the real economy and what happens with interest rates. Okay, interest rates, to the extent that there's a likelihood of a lower, a less aggressive monetary policy, I think we're going to see this part of the market potentially responding. And in fact, that's exactly what's happened in the last 2 days, yesterday and today, with the news that came out that the inflation numbers look like they're trending lower in a more sustained way. Okay? So pivoting to the inflation picture, what you see here is CPI inflation. You see in purple, you see a pretty big decline in the last couple of months of 2024. The 3-month average of inflation is now sitting at right about 2%, which is pretty close to the target for the Fed. It's still a wild card whether or not this trend will continue, but certainly yesterday and today what we saw was a reaction of the rest of the market moving up. And actually, let me focus in on this a little bit better. Right? You see yesterday the orange line, which is the non-mag rest of the market, right? You see the big jump there. Also, mid-cap and small-cap indices also jumped even more on the news of potentially lower interest rates in the second half of the year, right? And conversely, you saw this cooling of inflation and cooling of the economy actually also potentially hurting some of the, the big Mag 7 trade, right? So not clear. Obviously, we're not in the prediction business here of whether these trends will occur, but certainly we do feel that over the full cycle, having a healthy amount of allocation, of equity allocation to indices that are not going to be driven and pulled so much by what happens with the Mag 7 is, in the long run, the prudent thing to do from a diversification perspective. And with that, and I'll just close this. You know that I've been a big advocate of holding, healthy exposures to the mid-cap index and the small-cap index, as well as to the international index to a lesser extent, as counterweights, right, and as diversifiers to the S&P 500 that has been so beholden to the fortunes of these Mag 7 firms, which we're all rooting for them. We all hope they can meet these very lofty profit goals and expectations that are priced into the current levels. But nevertheless, the prudent thing here as a long run investor, right, is to make sure that we have a good diversification across the entire 3,000 plus universe of stocks. Anyway, it looks like I'm approaching the 15-minute mark here. So anyway, I hope you found this little overview helpful, and happy to answer any questions or concerns that this presentation may have triggered in your minds. Have a great weekend, and thanks.